A house doesn't make you rich. A stock doesn't make you rich either. But one of them quietly bends the math in your favor, and the other makes you believe it does. Most people pick a side early. Real estate is safer. Stocks grow faster. They argue about it like it's a personality trait. But almost nobody sits down and asks the uncomfortable question, what does the math actually say after everything is counted? Not the highlight version, the real version. Right now, this question matters more than ever, because both markets have changed. Property prices have stretched far beyond incomes. Stock markets move faster, swing harder, and feel more unpredictable. And yet, people are still making the same decisions using the same outdated assumptions. Buy a house. Hold stocks long term. Simple advice. But underneath that simplicity, the mechanics are very different. Let's start with the story most people believe. You buy a house. You take a loan. You wait. Over time, the price goes up. You build wealth. It feels solid, physical, safe. You can see it, touch it, live in it. And there's a powerful psychological effect in that, because even if prices fluctuate, the house is still there. Now compare that to stocks. You invest money into companies. Prices go up and down, sometimes sharply. There's no physical anchor, just numbers on a screen. So emotionally, real estate feels stable. Stocks feel risky. But the math doesn't care how something feels. Let's break this down. Imagine two people, same starting point, same amount of money, same time horizon, 20 years. Person A buys real estate. Person B invests in stocks. At first glance, person A looks smarter because they're not just using their own money. They're using leverage. Let's say they put down $20,000 on a $100,000 property. They control a much larger asset than they could otherwise afford. And if the property goes up 5%, that's a 5% gain on $100,000, not just their $20,000. So their return looks amplified, powerful, almost unfair. Meanwhile, person B invests $20,000 in stocks. If the market goes up 8%, they earn 8% on $20,000. No leverage, no multiplier. At this stage, real estate looks like the winner. And this is where most comparisons stop. But this is also where the math starts getting uncomfortable. Because that 5% gain on property doesn't come alone. It comes with costs. Mortgage interest, maintenance, taxes, insurance, vacancy risk, repairs you didn't plan for. And these are not small. They are constant. And they compound quietly in the opposite direction. Now here's where things get interesting. Because leverage cuts both ways. If the property goes up, your returns are amplified. But if your costs rise or your property underperforms, your losses are amplified too. And unlike stocks, where your downside is limited to what you invested, real estate ties you to ongoing obligations, monthly, yearly, relentlessly. Now look at person B again. Stocks don't call you at midnight because the roof is leaking. They don't need repairs. They don't sit empty. But they do something else. They compound. And compounding is where the real math begins to separate. An 8% annual return doesn't sound dramatic, but over 20 years, it doesn't grow linearly. It accelerates. Your money earns returns, then those returns earn returns, then those returns earn returns again. It's quiet, almost invisible at first, but by year 15, it starts to feel different. By year 20, it looks like a completely different system. Now here's the twist. Real estate can compound too, but not in the same clean way. Because part of your return is constantly being pulled out. Interest payments don't compound for you, they compound for the lender. Maintenance costs don't grow your asset, they preserve it. So the compounding engine is partially disrupted, which means your real return is not the headline number. It's the leftover after everything else has taken its share. Now let's zoom out, because the real comparison isn't just about returns. It's about flexibility. Stocks are liquid. You can enter or exit quickly. Adjust your position. Rebalance. Real estate is not. It's slow, sticky, expensive to move in and out of. And that changes behavior. With stocks, you can adapt. With property, you're committed. Sometimes that commitment helps. It forces discipline. But sometimes it traps you. Now add one more layer. Time. Over 20 years, life changes. Income changes. Opportunities appear. Person B can shift capital into new opportunities. Different sectors. Different markets. A person is tied to a location. A single asset. A single outcome. And concentration is a double-edged sword. If your property performs well, it feels brilliant. If it doesn't, it's everything. Now let's talk about something people rarely include in this comparison. The cost of being wrong. If you buy the wrong stock, you lose money. It hurts, but it's contained. If you buy the wrong property, you don't just lose money. You lose time, liquidity, flexibility. And sometimes you don't even realize it for years. Because real estate doesn't reprice instantly, it moves slowly, which can feel safe, but can also hide problems. Stocks are brutally honest. They reprice every second. Real estate is quieter, and that silence can be misleading. Now here's where the narrative usually breaks. Because people expect a clear winner. Real estate or stocks? Pick one. But the real answer is more uncomfortable. The winner isn't the asset. It's the structure. How much leverage you use, what price you enter at, how long you hold, what costs you carry, how disciplined you are. Two people can buy real estate and have completely different outcomes. Two people can invest in stocks and end up in opposite places. Because the math is sensitive. Small differences at the start become massive differences over time. Now let's address the myth that refuses to die. Real estate always goes up. It sounds true, because over long periods, in many places, it has. But that statement hides a critical detail. It doesn't go up in a straight line, and it doesn't go up everywhere. There are decades where prices stagnate, regions that underperform, periods where inflation eats the gains. The same is true for stocks. But stocks have one structural advantage. They are tied to productivity. Companies grow, innovate, expand, and over long periods, that growth feeds returns. Real estate, in many cases, is tied to location and demand, which can be powerful, but also limited. Now here's where things get subtle. Because real estate has one advantage stocks don't: forced behavior. When you have a mortgage, you pay it every month. You don't debate it. You don't try to time it. You just do it. And over time, that builds equity. In stocks, discipline is optional, which means many people don't benefit from compounding, even if the system allows it. So ironically, real estate sometimes wins, not because it's mathematically superior, but because it forces people to behave in a way that benefits them. Now step back and look at the bigger picture. This isn't just about choosing an asset. It's about understanding what actually drives wealth: leverage, compounding, costs, time, behavior, and how they interact. Because once you see those forces clearly, the question changes. It's no longer real estate or stocks. It becomes, where does the math work in your favor, and where is it quietly working against you? And that question doesn't have a universal answer. Because the system doesn't reward the asset. It rewards how you play it. So before you pick a side, before you commit decades of your life to one path, it's worth asking one final question. Are you choosing the asset, or are you choosing the version of the math that feels better, even if it isn't?